Hey, welcome back to The Dive. Our guest today is from a company that identifies which stocks to eliminate from an index. He will deep dive into their investment philosophy, technological disruption, and companies that were X'd out and made their way back into their portfolio. He is the founder and chief executive officer of XOUT Capital. David Barse is joining us today. But before we bring David on, just a quick reminder to smash that subscribe button if you haven't already. Hey, David, welcome back to The Dive.
Hey, thanks for having me, Cassandra.
Thank you so much for joining us. And I guess congratulations are in order for your documentary that's up for some awards, Summer of Soul.
Yeah, thanks. It's a project that I've been involved in for the last few years. We produced a film called Summer of Soul about a music festival in Harlem in 1969 that kind of rivaled Woodstock, which everyone does know about, but no one knew about this music festival. So we made a documentary about it, and it was just awarded Best Documentary Film by the Critics' Choice Awards this past Sunday. So we're very excited about it. Everyone should go see it.
Yeah,
it's available
amazing.
on Hulu. Available on Hulu. Yeah.
Okay, cool. I'm going to check it out after this. All right, so let's talk about XOUT now. You specialize in identifying which companies not to own. For our viewers, what are the major indicators you use to identify which companies to X out?
So we're really focused on what is an important forward-facing risk called technological disruption. There is no magic or crystal ball for how to determine what is being disrupted or who is doing the disruption. But we have certain fundamental economic factors that we focus on to try and ferret out who we think is being left behind. We're only focused on excluding the companies that are likely to get or have been disrupted. One of the most important metrics that we rely on is not just revenue growth, but the acceleration or deceleration of revenue that a company reports each and every quarter. And we try and measure that on a quintile basis, and we do it against all other of the 500 largest market cap companies. But we also look at labor. Are they hiring or reducing their labor force? How are they doing with investing in their own company and in research and development? What are they doing about buying back their own shares, and are they using free cash flow to do that, not borrowing money? And then we look at what the earnings reports have been. Have they been surprising the street to the upside or disappointing the street to the downside? So how well they do on their own guidance is an important factor for us in our metric.
Mm-hmm. Well, some people like Cathie Wood are suggesting that inflation will be offset in part by technology deflation. Where do you sit on the whole inflation debate?
Yeah, I have to agree with her. I think we've seen this in our own ETF over the last couple of years. As inflation fears spike up, technology stocks get temporarily impaired, and it causes a deflation, as she noted. I think what's really happening here is, those kinds of worries should not be a near-term focus for the technology companies and those companies doing disruption. It's a real impact to the ones that are lagging behind. But ultimately, these companies will continue to grow and thrive. They're thinking about what they're going to be doing from a business standpoint 3 to 5 years from now, not what's happening in this current quarter. So every time you see these inflation fears, ground swell up and then market prices get impacted in the near term, I think she's right. It's a deflation and therefore an opportunity to buy, not an opportunity to sell.
Mm-hmm, for sure. Okay, so let's talk about Chevron. You recently X'd them out despite high demand in the oil sector. Could you walk us through this?
Yeah, so Chevron has actually been X'd out since we launched, so for a couple of years. And the reason for that is it really scores poorly in all of our metrics. It has not been a company that has grown. In fact, as they've reported themselves, their own supply demand dynamics are deteriorating, and they're secularly deteriorating. This is a long-term secular declining company. And what's really happened to put this in focus is commodity prices have risen. And so as a result of the commodity prices rising, Chevron has had quite a year this year in terms of its stock price performance. But if you held Chevron for the last 10 years, you haven't made any money. And so other than what you get in a dividend yield, and we're not about an income-oriented portfolio, we're about just trying to exclude those losers that aren't growing or likely being disrupted. And Chevron writes about its own disruption in every quarter when it produces its financial statement. So it's a long-term XOUT and very likely to stay out of our portfolio for possibly ever.
Mm-hmm. Okay, so we saw that you have a large position in Nvidia. Recently, the UK announced a second investigation on Nvidia's purchase of ARM over security concerns. Does this kind of news have an impact on how the company will move forward?
Yeah, Nvidia is a great example of a true disruptor. This company scores extremely well in all of our factors and has been on the top of the list since we launched. It's performed quite admirably as well. I'll asterisk all of that with one of the risks that all tech companies face, and in fact, every company that's dealing with technology and disruption is regulatory risk. Whether this investigation has something to do with potential regulation that might impact its business or something otherwise, these are always risk factors which are very hard to analyze and predict. We don't use them in our model, but I do asterisk what I'll say. Nvidia is a great company. It scores phenomenally well. It's likely to stay in our portfolio, but we always asterisk that risk with what potential regulation might come down the road to impair or at least put a speed bump in the road for this kind of company, which I think will continue to grow.
Okay, yeah, great. Okay, so shifting to Tesla, you mentioned in one of your interviews that the market is misanalyzing Tesla. Could you give us some more color on this?
Yeah, look, I think you have all these analysts who are coming out with reports. There was a recent one a week or so ago, and it ran in Barron's about how Tesla should be really trading at $125 a share. So 10 times less than where it's trading now, in part because it's being compared to General Motors. And if you use similar valuation metrics based upon the number of cars it produces and will produce even into 2030, that's the right price for its stock. And I just think these are the kind of analyst reports that are just misanalyzing the company. The valuation metric for Tesla attributes no weight to its patents, to its goodwill, to its brand, to the loyalty that its customer base has developed, and to the lead it has in selling cars in the EV space and the data that it's collected, which no one has sought to put a value on. So we just think that the general community that tries to traditionally analyze a company like Tesla is wrong. And obviously the way it's trading in the market sort of supports that fundamental belief. But I think folks have to reevaluate the way they look at Tesla, and a traditional metric is just wrong.
Mm-hmm. Okay, interesting. All right, so moving on here. The SEC has rejected the next bid to become the first issuer of a physically backed Bitcoin ETF in the US, stating they're not confident the company can offer protections from the volatile price swings and potential manipulation of the market for the world's largest cryptocurrency. How do you view this type of news?
Yeah, I mean, right now there's no crypto company that or currency itself that's in our index, so we don't spend too much time focusing on it other than having an interest in these kinds of things. And I think the challenge the SEC is dealing with is that Bitcoin and other cryptocurrencies are not securities. And so they mask behind this notion that it's volatile and therefore they don't know if they can guard against it. Quite frankly, the reality is they don't have the authority to regulate because it's not a security and they're only responsible for regulating securities. This is why they keep forcing issuers who are seeking to create ETFs along the side of cryptocurrencies as futures underlying portfolios, because futures are securities and they can regulate those. So this whole notion about them saying they can't regulate because it's volatile is kind of, I would say, a ducking of the real issue here. The real issue is they just don't have authority to do it. And that's the challenge for them.
Okay, interesting. All right, well, thank you so much for coming on the show today, David. We'll follow up again soon.
Thanks for having me. It's always fun.
Thanks so much for tuning in today. We'll be back again tomorrow with more great coverage, so be sure to stay tuned by hitting that notification bell and smashing that subscribe button.